As a reminder to investors, the Ascent Income Fund is an open-ended evergreen fund that targets first mortgage opportunities, where EM is originating loans on the basis of coming in a super senior position. We find this strategy even more compelling in the current environment, as we're able to see some enhanced yield and a current coupon via interest payments on a monthly basis. So, as the banks started seizing up and conventional lenders start sloughing off and falling by the wayside, debt funds and other opportunistic lenders play a more important role in originating new, compelling first mortgage opportunities, and that's where sort of EM finds it has a competitive advantage. We've built up a network of brokers and borrowers over the past 6 to 8 years, which is sort of comprised of, roughly 20,000 active broker and borrower connections. And sort of what that equates to on an ongoing basis is a larger target origination, top of the funnel, to the tune of about $140 million on a rolling monthly basis, which sort of equates to around $1.4 billion of new loan opportunities on an annualized basis. What we're seeing on the originations front is quite a bit of compelling opportunities that were otherwise saved for bank lenders, regional lenders, life insurance companies, CMBS and more permanent type groups. We see quite a bit of multifamily, mixed use, largely residential product that was otherwise, not an option for sort of the more sort of the debt fund markets, because a lot of those sponsors are looking for lower interest rates historically, whereas now, just because of the uncertainty in the markets, the most important thing is really ease of execution and certainty of execution. So to the extent that these sponsors can find lending relationships like EM, where they expect a timely close and have certainty of execution, they're willing to pay a bit more in yield or in interest cost in order to have that certainty or peace of mind that their lender relationship will be there at the closing table. And so really what that means is we're seeing quite a bit of solid loan opportunities, low LTV deals, sub 50, 60% of appraised value in most cases. Many or most of our deals are either cash flowing or carry a full term interest reserve. So there's that certainty of interest payment, being made on a monthly basis via cash flow or via reserve. And, a lot of the sponsors and borrowers that we're working with are extremely well capitalized. They're only, taking out loans due to necessity, due to, impending maturities. And really what that means is we have sort of our pick at the highest end of the borrower spectrum. So these are the folks that were otherwise bankable or have, very solid credit profiles, solid liquidity profiles, and are able to keep their loans current on an ongoing basis. So generally speaking, that sort of pushes us to, trying to originate these opportunities that are extremely strong on a risk-adjusted basis. We're not taking equity-like risk, but sitting in that first mortgage position, we are able to call the shots for lack of a better term. We can oversee operating accounts. We have the ability to take a pledge of the equity in the individual deal, which allows us, in the event of default, to really control the path of that deal going forward and not be beholden to a sponsor or borrower that's in default. So we feel that this is an extraordinary time to be lending. As I mentioned, where we're seeing a lot of competitive opportunities. We're competing with some of the largest private lenders in the space. And we're doing it in markets where we see, compelling stories, not just top 100 MSAs, but MSAs where, there's really a strong story and a path to growth, not only from a residential basis, but commercially as well. Most of the deals that we're targeting are either in the multifamily or residential space, industrial, or are cash flowing, solid self-storage or office deals that we've found through our opportunistic originations channels. So, to summarize, I think this is a great opportunity to focus more on the debt space. We do still see quite a bit of equity opportunities, but less compelling, again, due to the rising interest rate environment. We find that it's a good time for us to shift more toward the credit and ongoing income producing assets where we can sort of effectuate control on an ongoing basis.